Hi everyone, this is Charles from WatchCharts.com. I was inspired to make this video today because I came across an interesting article from a website called riskconcern.com, which discussed the risk of investing in luxury watches. And this article came out, I think, around January of 2022, really right before the peak of the watch market, which happened around March or April. And I thought it was a really sensible and reasonable take on watches as an investment in the midst of what was a very volatile and unprecedented time in the watch market. And so I wanted to make this video today to share our honest opinion on whether watches are good investments and maybe approach this question from a different perspective than what a lot of other people have done on YouTube and on the internet. But definitely check out the article from Risk Concern. I'll link it in the description below. And of course, check out WatchCharts.com if you're looking to research prices for over 20,000 watches. Check out the watches for sale from private sellers on our marketplace and track the value of your watch collection. So I'll start this video by discussing what is the bar for a good investment. What do we mean when we ask the question, are watches good investments? How do we then evaluate watches as an asset class for their investment potential? I'll share a real-world example, which I think is quite eye-opening, and I'll end with some of my key takeaways and my opinion on watches as investments. So what is a good investment? I think the first thing I'll say is just making a profit is not a high enough bar to classify something as a good investment. For example, if I invest $100 into something, is my investment good if in a year I get back $90? Well, definitely not, right? $101? Still probably no. 110? Maybe. 150? Almost definitely. But where is this bar exactly? How do we quantify this bar? There's a couple of different ways, but what I would propose is to use the S&P 500 as a benchmark. Over the last 100 years, the S&P 500 has returned a compounded rate of roughly 10% a year, and its performance over a long period of time has been relatively consistent. Yes, there have been, of course, years where the market was down, but overall, it's quite well understood that a rate of roughly 10% a year is the standard for the overall financial market, at least in the US. And so in order for investment to be good, my claim is that it must match or outperform the S&P 500. Otherwise, it's just a lot safer and easier to just buy the S&P, and anyone can do it. It requires no stock picking ability, no insight whatsoever to simply buy this index fund. So now, how do we actually evaluate watches as investments? We can't really evaluate them like traditional financial assets such as stocks and real estate, which derive their value based on their ability to generate cash flow. You invest in a stock, you receive a dividend, you're giving money to a company so that they can use this money to then grow and create some sort of value. Similarly with real estate, you're investing in a house, commercial real estate, whatever it is, because you can collect rent. Also, you can't really evaluate it like a commodity because commodities derive their value from their utility as raw materials. They can be used as energy sources, for manufacturing, as a food source, etc. Luxury watches do not offer utility in the traditional sense or generate cash flow. So their long-term value is really tied to their demand as status symbols and as objects of beauty and craftsmanship, which is why, as enthusiasts, we appreciate them. So evaluating watches is fundamentally about understanding cultural dynamics, actually. It's much more abstract. It's about understanding fashion trends. It's about understanding the luxury goods market, the demand for luxury goods, how many people there are that can, that have the disposable income to buy luxury goods at different price points, and so on. I think it's also important here to make the distinction between organic and artificial demand. So I would say that organic demand for luxury watches is driven by people who are buying the watch for its utility that it can provide, which is basically status and enjoyment. We appreciate the watch for its beauty, for its craftsmanship, for its engineering, for its history, and to be honest, a lot of people who maybe aren't enthusiasts will still buy luxury watches because it's a recognizable status symbol. And then you have artificial demand, which is driven by factors that are extrinsic to the watches themselves. So this is someone who's buying a watch for a secondary reason, not for necessarily what the watch is in and of itself, but maybe, for example, because they're told that watches are good investments, so they should buy a watch. Or maybe because they hear that it's extremely difficult to buy a Rolex at retail, and if you can buy one, then you can then flip it on the secondary market for a 50% or a 100% profit, for example. So this is a type of rent-seeking behavior. Or maybe they buy it because they want to manipulate the market through artificial scarcity. If they can accumulate a large amount of inventory for a particular model or a particular brand, then they can then control the supply of this watch, and then when the demand comes, they will basically be able to charge whatever price they ask. When it comes to artificial demand, I think another interesting thing to bring up is the notion of the greater fool theory, which means that an asset that is overpriced, for example, a watch, can still be a good investment as long as I believe I can find someone else to sell it to at an even higher price than what I bought into. So maybe I know that, okay, this watch skyrocketed in value over the last couple months. It's probably overpriced, but hey, I think, I can find someone else that's willing to, take the bag off of my hands. The problem with this, and this is generally sort of the type of behavior that creates a bubble, is that eventually you run out of fools. And I think that that's sort of what we saw happen when the watch market downturn began in the second quarter of last year. You saw this astronomical rise in prices. We estimated through our overall market index an increase of 24% in overall prices just within the first quarter of 2022 alone. And then eventually, it becomes unsustainable, the scales tip, and now you have a ton of people who really only bought the watch so that they can sell it to the next person at a 5% or a 10% premium, whatever it is. And now suddenly you can't find anyone to take the bag off of your hands, and you have no choice but to liquidate at a significant loss. And then you have a lot of people doing this, and that's how the downturn begins. So regardless of short-term trends, because after all, this is a video that's intended to focus on watches as a long-term investment, let's look at a real-world example. And I have a pretty interesting one. This is a 1978 Rolex GMT Master, reference 1675. I found a listing on Chrono24 for this watch that's currently listed at $31,000. According to Crown & Caliber, the retail price of this watch back in 1978 was $795. So let's assume you have a guy that bought this watch in 1978 for its retail price of $795. They kept it in perfect condition, never wore it, and let's imagine that there's no cost for servicing, storing, or insuring the watch. It costs them nothing to maintain the perfect condition of the watch, and now they choose to sell it today. So they're asking $31,000. Let's say they're able to realize that price. That would mean that they have a return of 3,900%, $795 back in 1978 versus $31,000 today. That sounds really good, right? Return of 3,900%, except when you compare it to the S&P 500, you realize that the S&P 500 returned 16,185% in that same period. So for example, if you had taken the same $795 back in 1978 that you used to buy that Rolex GMT Master, today you would have more than $128,000 if you had put it into the stock market. And so today you would have more than 4 times as much money as you did if you had bought a GMT Master, even if you ignore servicing, storing, and insurance costs, and even if you assume that today you can realize your asking price. So what are the key takeaways? I don't think it's reasonable to categorically reject watches as investments, but the truth is the vast majority of watches are going to underperform the stock market. Most watches will depreciate in value after you buy them, and even the blue chip brands, right, Rolex, Patek, AP, I think it's going to be extremely difficult to pick one of the few watches that are probably going to appreciate in value. Even the watches, if we think back to the vintage era of maybe 60s, 70s, 80s watches, the ones that performed really well, like we all think of the Paul Newman Daytona, they were relatively unpopular watches at that time. So picking something that is maybe underappreciated or overlooked in the current era, and then being able to have some conviction, some deep understanding of fashion and luxury trends over a multi-decade period, it's going to be extremely difficult and honestly just probably requires a lot of luck. You might get lucky once or twice, but developing a repeatable investment strategy is going to be extremely difficult, if not impossible. You also have to factor in the costs of transacting, the costs of servicing, the costs of insurance, the costs of storage. over a long period of time, these costs are going to eat into the margin that you can actually realize. But of course, at the end of the day, it's your money and you're free to spend it how you choose. But my advice would be to distinguish between buying for enjoyment versus buying for investment. I think a lot of collectors, especially over the last couple years, have used investment as sort of this excuse to have your cake and eat it too. But I think this is just a little bit unrealistic. Statistically speaking, I think it's incredibly unlikely that the set of watches that you enjoy, that you like, that you want to buy are also going to be the select few that may possibly turn out to be good investments. Our platform exists to bring transparency to the market by establishing a baseline estimate for fair market pricing and a fair market range, and our historical data can help you assess short-term risk based on the economic conditions for the overall watch market and the specific watch you're interested in buying. At the end of the day, I think it's just important to be realistic and reasonable with your expectations. Are there watches out there that can match or outperform the market over a multi-decade period? Probably. Will you be able to create a methodology for identifying these watches that is going to be repeatable? Probably not. And will you have to sacrifice the enjoyment of being able to buy what you like and actually wear the watches that you're buying? Definitely. But again, this is all just our opinion. I'm interested to hear what you guys have to think about buying watches as investments in the comments. Let us know your thoughts, and we'll catch you in the next video.